Today, we are looking at the delayed takeoff of the merger between Hawaiian Airlines and Alaska Airlines, and the method of investment that could have delivered an arbitrageur a return in excess of 800% on the deal. We'll do a brief recap of the details of this proposed takeover, and then get straight into the numbers. In particular, given the long duration of this takeover, we'll ask the question: would an investor be economically better off by investing at the time of the announcement, or waiting until closer to the completion date? I hope you find the content useful, and if you do, I would be awfully grateful if you would drop a like and subscribe. It would really help me with the algorithm in building the channel, which could be critical if I lose my job for giving away all our secrets. On the 3rd of December 2023, Alaska Airlines announced that it had agreed to take over Hawaiian Airlines in an $18 all-cash transaction. The boards of directors of both companies were in favor of the deal, and all that was required to close was to secure regulatory approvals and approval from the shareholders of Hawaiian Airlines. Hawaiian Airlines is the largest airline operating in Hawaii and the 10th largest airline in the United States. Founded in 1929 as a short-hop airline for the islands of Hawaii, the airline has since grown to 66 jets, serving 33 destinations and generating annual revenue in excess of $2.5 billion. Alaska Airlines is the 6th largest airline in the United States and is, oddly, headquartered in Washington. The airline was established in 1932 and has a long history of mergers and acquisitions, the first completing in 1934. Today, the airline boasts 319 jets, serving 128 destinations, and annual revenue in excess of $9 billion. The noted rationale for this takeover is to position the enlarged company to capitalize on growth opportunities, to manage costs, and to better serve customers. The mechanics of the deal are perfectly simple. For each share in Hawaiian Airlines owned by an investor, they will receive $18 in cash when the transaction closes, which we estimate to be in March next year. There is no short position with which to contend, nor any dividends forecast to be paid. The interesting part of this deal, given the estimated 15-month duration, is whether an investor would generate a better return investing today, with a shorter total holding period, or in December 2023 when the deal was first announced, and holding the position for more than a year. If we assume an investor took a long position the 2nd of December 2023, at the then market price of $14.20 per share, and held the position until close, they could expect an unleveraged return of 26.76%, which equates to an annual return of 20.56%. This is lessered due to the position being open for longer than a year. The risk-adjusted return is negative 8.87% due to the downside share price should the deal fail to close. The absolute loss an investor would face should the deal fail to close is 69%. Now, if we consider that same investor waiting to take a long position in Hawaiian Airlines until this week, now that the deal has been tacitly approved by the U.S. Justice Department, we can see how the returns profile differs. This investor would take a long position at $17.48 per share, but would hold a position for an estimated 270 fewer days. Here, the expected return is 2.97%, which equates to an annual return of 5.3%. The risk-adjusted return is negative 43.19%, again due to the significant downside price risk of the deal failing to close. The absolute loss this investor would face should the deal fail to close is 74.83%. We can therefore see that, in this particular instance, the investor taking a position when the deal was first announced and holding until close is financially better off on both an absolute and annual basis. Plus, they also have a lesser downside risk. However, the actual answer is that neither of these positions would have delivered the best returns for an investor. An astute arbitrageur is well aware that in a takeover which boasts the combination of a long holding period and the possibility of regulatory hurdles, the share price can actually slide after the initial jump. And so was the case with Hawaiian. Prior to the announcement, the shares of Hawaiian Airlines were trading around $4.50. This quickly jumped to over $14 when the takeover announcement was made public. However, As the timeline dragged on and investors decided to realize profits and cycle their cash into other opportunities, the share price sunk to around $11.50 by the end of July. So, what if the patient arbitrager had waited until July, and let's assume they missed the absolute bottom, and bought in at $11.84 per share? In this instance, the investor could expect an unleveraged return of 52.03%, which translates to an annual return of 80.81%. The risk-adjusted return is now positive 45.13%. This is because the spread between the purchase price and the downside price has reduced and the probability of the deal closing has increased due to the Department of Justice decision. The absolute loss an investor could face is still high at 62.84%. However, there is a final way the investor could have participated in this transaction. Again, we assume a delayed purchase in July for $11.84 per share. However, this time the investor sells the position after just 22 days, or the share price reaches $17.68, sufficiently close to the offer price to no longer make the risk of holding the position a sensible option. Here an investor can expect a return of 49.32%, marginally less than holding to close. However, the annual return now increases to 818.34% due to the incredibly short holding period. The risk-adjusted return stands at 446.16%. The absolute loss, should the deal have failed during the 22-day holding period, would have been 62.84%. These final two methods of committing to the deal require significantly more active monitoring and management than committing at the outset. However, they clearly offer the active investor far superior returns. These are the secrets of arbitrageurs that are not typically shared with outside investors. What do you guys think of this takeover? Let me know in the comments, and don't forget to like and follow if you found this video useful. Be aware that all the figures mentioned are at the date of my calculations and will change in line with the share price of the company, any change to the takeover price, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you, and until next time, enjoy life.